Hey everybody, today we are going to talk about dividends. We're going to look at some two stocks that are both yielding more than 5% that we think are great buys right now. Tyler Crowe is joining me. Before we dive in, please take a minute, check out the link you see on your screen, fool.com/Frankel for the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way you can support this work we're doing on YouTube. Again, that is fool.com/Frankel. So we're going to talk about two stocks, and surprise, surprise, coming from me, they're real estate stocks. Um, but there are some really interesting opportunities in real estate right now. With interest rates are up, so the stocks have been under pressure. There's a lot of real estate sectors that have just fallen out of favor, and one of them is retail. Um, so, a couple of stats that might surprise you. Don't buy that the malls are dead narrative. If you go to a good mall, a high quality mall, you'll see that the exact opposite is true. And I'm going to be talking about Simon Property Group. Ticker symbol is SPG. And I know Tyler is out of the country, but lives near a Simon Mall. And I imagine it's not dead. Is that
Far from
correct?
it.
Would that be fair to say?
Far from it.
Far from it. So, retail vacancies, and I was surprised to hear this statistics. Retail vacancies are at a near record low rate of 4.1%, even though rent has risen over the past few years steadily. The reason is that think about what's happening to the retail space. Everybody lives near a mall that people used to go to, right? Or had one in your neighborhood. The mall that people used to go to, 20 years ago that was open 10 years longer than it should have been. We had one of those in Columbia, South Carolina that just got demolished to make way for a more modern development. So a lot of retail space has been demolished over the past few years. Specifically, according to CoreSite, 155 million square feet of mostly older retail space has been demolished over the past 5 years alone. And that has kind of created a supply demand imbalance, but in the opposite direction that a lot of people think are happening with retail spaces. So, retail honestly costs a lot to build. It's not a cheap type of property to construct. Think about like what goes into constructing, a self-storage facility or an office building that is very much just like a shell. Whereas malls, especially good malls like the modern ones, are full of amenities, really nice construction, very well put together, expensive buildings to construct. So it doesn't justify the construction costs to a lot of developers to build those, but that all those old retail spaces being demolished has created kind of a supply constraint that isn't likely to go away anytime soon. So Simon is, when I say good malls, there's Simon and then there's everyone else. Simon's malls are the best in the business as far as just like like one company's malls. It owns a lot of malls under the Mills brand name. It owns a lot of outlet malls. If you've ever been to a premium outlets property, that's a Simon property. They're the top of the class, and it's because Simon has invested in all of its properties over time. Simon actually operates the oldest mall in America. It's been operating continuously for about 60 years. And the reason it's still operating and still thriving is because the company has put money into it over time to make it modern, to make people to add the amenities that people want, to prevent it from getting out competed by another mall across town. And that's kind of Simon's business model. The company has about $11 billion in total liquidity, about $3 billion on its balance sheet. That gives it a lot of capital to keep its malls ahead of the curve. Um, if you look at its numbers, the net operating income grew by 4% year over year. Occupancy increased 110 basis points over the past year at Simon's Malls. And the base minimum rent that it charges to tenants has increased significantly. So I really like Simon here. I think its valuation is still very low. It's focused on its small businesses. I don't know if you were aware of this, Tyler. They are getting out of the business of actually owning retailers, which was kind of a silly business they got into.
Good.
Right when they bought J.C. Penney and when they bought what was the other Brooks Brothers, I think is one that they bought. Forever 21 is the big one they bought. They bought it with partners. It sold its remaining interest in Authentic Brands Group recently for almost $1.5 billion. It still has a few partnerships, but it seems like it's exiting that business slowly but surely. Um, Simon's really good at running malls. They're not, they don't need to own retailers. I don't, I wouldn't want to own J.C. Penney right now. So I'm really glad that they're getting out of those type of businesses. And I just think they're doing a really great job. And I think that the supply demand dynamics are more favorable for retailers than people think. Tyler, I think you have a retailer also to talk about.
Yeah, it's funny. We're circling the same area recently because, as you said, with malls, but the same thing's actually happening in strip malls, strip centers, and just kind of retail in general. I mean, you were throwing out some interesting stats in terms of vacancy and stuff like that, but here's another really good one for you. In retail completions, which basically means like how much retail space is being built per in the United States at any given point. In about 2017, in the second quarter of 2017, excuse me, we had about 4.5 million square feet in terms of, or 4.5 million completions in terms of, total square feet added of retail space in the United States. It's in the third quarter of 2023 that it declined all the way down to 584,000. So we're getting down to, 80% down in total completion. So not only are we seeing the regional malls go away and kind of the dumpy class B minus C malls that everyone doesn't want to go to anymore because they were anchored by some Sears that went out of business 7 years ago. Uh, but instead, we're left with less retail space, which finding out people still want to go to retail through, either through direct pickup or any other means to actually kind of leverage both online and physical space, that omni-channel business model. And so one of the companies I've been looking at, I've circled it for a long time, but it's becoming much more interesting to me lately, is Kimco Realty. Uh, uh, like I said, they mostly do strip malls. The vast majority of their properties are going to be anchored by a grocery. So, whether that be a publicly traded one or some of the kind of specialty grocery, I guess you could call, like H Mart, which is an Asian grocery store or something like that. So I think 85% of their entire portfolio of strip malls have an anchor tenant that is a grocer, which drives traffic to strip malls at orders of magnitude larger than you would see at a non grocer retail. And if you look at it too, its largest I guess you could say its largest tenants are either grocers, or you're starting to look into like the large big box anchor tenants like a TJ Maxx, Ross Stores, PetSmart, things like that. So you have a nice quality tenant base. And this is where it starts to get interesting. I know we've talked a long time about like industrial rents, how we were seeing things like 20, 30, 40% lease spreads, right? Well, according to Kimco, in the most recent some of its most recent presentations. Right now, it has for its anchor tenants, like those big box retailers that we were just talking about. Right now they have about a 39% lease spread on their existing tenants. So when TJ Maxx or a Home Depot is coming to re-sign their leases, which are 7 to 10 years, they're pretty long. We're looking at 30 to 40% growth in terms of the actual amount that these companies are paying for the spread, and that is largely due to a lack of completions. We have a lot of destruction or kind of obsolescence of real estate, or retail real estate specifically. So the retail market is looking much better than it did. I don't know, when were we talking about the retail apocalypse? What was that, like 2018, 2019, somewhere around there?
Yeah, shortly before COVID.
Yeah. So that is largely I think kind of become a myth now. And on top of that, despite the rather astronomical growth in rent, according to Kimco's management, rents are still going to have to increase at least another 30 to 50% just to start justifying like new developments. So you have a lot of embedded rent growth already built into what looks like a pretty attractive investment right now. And on top of that, Kimco is like I said, mostly strip malls, but they're also starting to get into that um, mixed use development. So on top of some of its larger strip mall facilities, you're actually starting to get some mixed use where they'll have like apartment complexes on top of anchor retail or something like that. I know the last time I think I saw it prominently was like I think you and I were in Alexandria, Virginia, and it would be like a 15-story apartment building that has an anchor tenant of like Whole Foods at the bottom. That's the kind of thing I'm talking about here, and this is what Kimco is seeing a lot of its strip malls and better properties where it's like we can actually do these into mixed use developments. Maybe toss in a very, very small amount of office for like, I don't know, a WeWork type flex office development, maybe a little bit of, recreation, experiential real estate. You have a lot of, because many of its strip malls are considerably larger than you'd think of, like the two stores with like a hardware and a grocery store. So on properties like that, it has a lot of upward potential growing from just being a traditional strip mall owner to kind of these mixed development, which allows it to really build upon some of its existing assets.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.